Well, hello and welcome to Trading Blows from TraderX. Another busy show ahead as the second quarter of 2022 gets underway. We discuss with the panel what to watch over the next 3 months, the key market drivers and macro stories that are likely to be top of our minds as we go through the next quarter into the summer. We'll also have a look at whether the bull market in equities has the legs to continue for some time to come. We'll discuss how OPEC's surprise output cuts over the weekend could impact both the financial markets and the broader macro economy. And we'll also have a look ahead to Friday's US labour market report as well. Let's get into the show. So with that said done, let's meet our panellists. As always, they'll go head-to-head over 4 rounds. They will score points for a great response, and they've got the threat of points being chalked off if a dispute is raised over their answer. Of course, the better the response, the more points they will score. Joining us this week, Ryan Paisey, the founder of PiQSuite, a market intelligence and news platform. Adam Linton, head of the European desk at Newsquawk, providing real-time audio updates whenever market-moving news breaks. And finally, last but not least, Richard Matthews, the founder of Pardus FX, a specialist FX provider for corporate, institutional and high net worth clients. With that all out of the way, let's get into the first round. So the second quarter of the year is upon us. It was probably quite a rocky start to the year. I think most people will be relatively glad to put Q1 behind us. It was certainly a rollercoaster ride for the markets with a lot of unexpected shenanigans going on, particularly in terms of financial stability in the month of March, as market expectations in terms of monetary policy did a little bit of a U-turn. Looking ahead, though, I want to come to you first, Adam. What should we have on the radar as we move into Q2? Let's get the crystal ball out. What do you think are going to be the key themes and events and risks that are really driving the markets over the next few months?
Yeah, sure. So, I think first it's important to kind of caveat this, where in 3 months' time when we sit down, we'll probably talk about something completely different to anything that we cover now. 3 months ago, I don't think anyone had even heard about Silicon Valley Bank in this kind of forum, let alone was thinking it was going to collapse and cause some of the turmoil that it did.
I can't remember what was going on 3 months ago.
If you kind of want to, the way that I'm kind of like framing things at the moment is kind of this G10 central bank tightening cycle and kind of where this ends up. I think there's a lot of focus in May. Obviously, you have the Fed meeting, you have BOE meeting, an ECB meeting. And I think, Q2 will likely be a phase where we kind of see this tightening cycle pause. I think we'll probably get another hike from the Fed and the BOE. But I think ultimately that will make us arrive at terminal. But then I think the key thing to consider is what is the justification for arriving at terminal? Is this a case of central bankers potentially feeling they have enough tightening in the pipeline, that they can fight inflation and there's going to ride things out? Or is there kind of more concern over the financial sector? Or is it potentially a growth slowdown? We saw the ISM data was pretty soft on Monday. We saw jolts yesterday. Then we've got big jobs reports also to come out on Friday. So I think it's like the nature of any potential pause will be kind of the main theme. Then also, if policymakers do enact a pause, I think it's kind of a case of watching out for how far is the door left open to potential further tightening down the line. We saw the RBA stand pat this week, and they kind of left the door open to further tightening. So it's not a case of, okay, we could pause here, but is there the scope for further tightening? And if there is, then that will obviously kind of weigh on the second half of the expectations, which do look for rate cuts and the likes of the Fed. I think also it's worth looking at potential divergences within G10 FX. I think the ECB is one to watch. You could potentially, actually see a bit more of a convergence if they keep hiking and the Fed potentially pauses. I think for FX markets, that'll be a key driver for euro dollar. As over the ECB, I always think they'll kind of be the first to lose their nerves. I'm not necessarily holding out too much for that. But I think within the G10 space, that's kind of things to watch. And then elsewhere, in terms of other issues, don't forget it's earnings season, which always creeps up upon us. I think we've got the banks kicking things off on 14th of April, something like that. And then elsewhere, it's kind of other issues I'm looking out for are this China recovery, how much more legs does it have, and then anything going on in the energy market.
That's a very good point on earnings season. I think it is the 14th of April that all of the banks kick off. As you say, it seems to come round quicker every time. Dick, a lot to digest there. In terms of central banks, we've obviously had the RBA this week hitting pause. We were discussing in the office earlier in the week that there's probably actually a stop in terms of the tightening cycle. The Bank of Canada have already done so. Is that your big theme for the second quarter as well? Who pauses next and who carries on tightening for some time to come? Or are you watching something else altogether?
I think it's one of the themes to watch, and I suspect a bit like in the first quarter, you're going to see a couple of unusual things pop up and surprise us and catch us unawares, like oil did over the weekend. I'll come back to central banks in a minute. So I'm going to be watching oil, war in Ukraine. So I just feel that's going to accelerate a bit. The banking sector. What's Ryan giggling about?
Oh no, it's just the way you said it. It's just the way you nonchalantly said, "Yeah, I'm watching
war."
I was like, all right, fair enough.
Why not?
He's gone.
The banking sector. So I still don't think we're out of the woods there. Jamie Dimon alluded to the fact earlier in the week he should complain because he's the main beneficiary out of it all.
Yeah.
And is inflation really dead and buried? I'm not convinced it is. There seems to be increasing problems in the food market. There's a drought in the Midwest, also Saskatchewan, which is a place I love, and in Argentina, and obviously in Ukraine. So we could get some pressure on the upside. So I'm not a softs trader, but I'd be watching wheat quite closely and probably be looking to buy something there because they can't plant. There's a side one there. In terms of recession, I think that we are starting to see the signs of it in the States. The ADP number that just came out was much weaker than people expected. Jolt's figure last night was weak as well. So I think we're starting to see some signs there. And I think I do agree with Adam that you're going to see some divergence between the States and the rest of the world. The UK, despite that idiot Tenreiro yesterday, we've got massive inflation over here.
You're going to get a point just for that. That's the only reason you said it. You're getting a point for it.
Tenreiro, I love that name. Tenreiro. I think I'm certainly in the Hugh Pill camp. I think they're going to have much more tightening over here, and I also think the ECB will tighten more, which will lend some power to both the euro and sterling. So I'd probably be looking to buy the euro, buy wheat, and gold. There you go.
And of course, you can trade all three of those things with Pepperstone. Ryan, what are you watching as we move into the next 3 months?
I'm watching everything, mate. You know me. Everything from softs to Babe Station.
Oh, God.
So regarding...
that's minus a point, isn't it?
Well, let's not get carried away. So regarding central bank divergence and stuff, I think it's very, very peculiar that none of you lot have mentioned the Bank of Kiwi. Bank of New Zealand this morning, unexpectedly hiking 50 basis points. That's bearing in mind that, what you'd say is their kind of like, their brother from another, Australia. Bear in mind, they've just halted hiking and insinuated that, we're probably not going to be hiking again unless stuff changes. Unexpectedly, I think Reuters had it 21 out of 24 economists said they were going to only hike by 25. They hiked 50. It wasn't even a dovish hike. I hate that. It wasn't a dovish hike 50. They didn't say, okay, this is it, we're done. They were kind of saying we are still in a bit of trouble. So I think that's 100% that the two, my right honourable friends before me have nailed it with. There is divergence going on in tradable currencies. I specify tradable currencies because, there's a lot of central banks out there that liquidity on the pairs and stuff, you just wouldn't want to go near at the best of times. So that was just more of an agreement and to doff my cap to my two friends there. In terms of what I'm watching for the new quarter, obviously new quarter, new flows, and it's flows that drive markets. There's signs, tentative signs, some will say there's very clear signs that flows are coming back into risk assets. And by risk assets, I mean stocks as much as anything else. Obviously, if the US are kind of, if the job market is coming on into where the Fed want it, then, it gives more onus that they don't have to hike. I think when latest Fed watch pricing was about a 50-50 for May 2nd meeting. And there's even the tiniest chance, I know it's a negligible percentage chance pricing wise, but there's like a 6% chance for cut in June. Obviously, a lot's got to go right for that to come about, but still, it gives you an idea that there is. Pardon? Oh, sorry. Yeah. Sorry. Yeah, exactly. But in terms of, in terms of what to look for, in terms of, where that flow is going to come from, what has annoyed me for Q1 is everyone is saying that
just one thing annoyed you.
Well, okay, yeah. There's been a lot of things. There's been a lot of things today that's annoyed me, to be fair, but that's just me being me. Everyone's saying that everyone that you see on social media and whatever is saying that everyone else is bearish, right? However, we know that's balls, right? Because Goldman Sachs put out a note this morning, or it might have been yesterday, towards the tail end of March. They're saying some of the most aggressive hedge fund buying of equities that they've seen in a long time. I think the prime book saw the largest notional net buying. So this is like new longs rather than short covering. Higher since September 19. And I think it was the ratio of longs being added to versus shorts being added to was 2.5 to 1, which is, you don't get that in a market where people are trying to sit on the fence. Okay. And as I said before, flows move markets. In terms of what else to look for, more macro, geopolitical factors to include, obviously, what's going on in Russia and Ukraine. You've now got to add Russia, Finland, because obviously Finland just joined the NATO group, the bloc or whatever you want to call it. Sorry, there was a train going past. If you can hear that. Russia have already made some comments about they're going to shore up that border with Finland, which puts people on edge. Sweden are about to be, well, hopefully, touch wood, come into NATO as well. It just throws more kind of unknowns into the whole dilemma. Also, again, watching war, as my good friend Dickie says, Israel, Iran, that's not going anywhere. It's one of those things. Everyone is always saying it's about to kick off, and it never does, thankfully. However, we are getting closer and closer to this reddest of red lines that Israel have set regarding the enrichment of uranium. We're still waiting to hear back from the international body, like IEEA, regarding some very highly enriched uranium that was detected. It's kind of said it's an accident. I'm not sure how you enrich uranium by accident, but I'm not a marine biologist.
We've all done it, haven't we?
Yeah. Well, this is it. So there's that to watch. Like I said before, it's one of these things. It's not an issue until it really is an issue. I wouldn't have positions based on it, but I'd be prepared to react very quickly. And I think that's a very key point for a trader. You may be sure that something will happen, but you have a cost to carry. Having a position waiting for something to happen can cost you a lot of money. So rather than be in that position, what I would like to do is I will have this is what the instant positions I'm going to put on if this happens. And if you have that memorized, then it's, muscle reflex, something happens, boss, do it like that. Because honestly, I know, on Twitter and whatever, you see perma bears and like people that have had these positions, paper positions for years, almost it seems. And then when the market does come off a little bit, they claim a victory. Well, however, if they would have sold when they first started talking about it, they've done their arse. But cost to carry doesn't exist on Twitter, right? Or social media. But also, and then finally, obviously China, it's obviously the permanent red, I would say elephant in the room, but I guess with China, I would say it's the dragon in the room.
Very good.
Thank you. Yeah. I've been working on that one. It's, put it this way. The bottom of the line is, bottom line is, it's not going to be a quiet quarter. And if it does, that'll be a black swan in itself.
No, I think you're absolutely right. And to go back to what Adam was saying earlier on, I think we are almost certain at the end of June, beginning of July, to be talking about totally different themes to the ones that we've all just come up with, such as the way of the markets at the moment. In any case, let's dig into the equity market a little bit more in the second round. So, equities, Dick, I want to start with you. I know the definition is one that we're not all huge fans of, and one that I don't particularly subscribe to, but the Nasdaq is over 20% off the lows that we saw in the fourth quarter of last year. So if you're a financial journalist, that allows you to write all of the snazzy, fancy headlines around us being back in a bull market, and the S&P 500 isn't too far off that milestone itself. We did snap a 4-day winning streak yesterday, but now we've broken above that resistance around 4,050. The bulls do seem to have wrestled back control there. it seems everyone's breathing a big sigh of relief. Financial stability risks seem to be behind us. Touch wood, cross our fingers, all the rest of it. Do we think the market is right to do that? Do we think this rally is sustainable and it's got room to extend further to the upside? Or is this kind of a flash in the pan and very quickly the bears will be back in control of the room? Dick, what are your thoughts on the equity space at the moment?
I think that I can't believe we're in a bull market. I actually saw that you wrote that yesterday. I just think it's remarkable that we're in a bull market. I think it's remarkable
in terms of the definition, or remarkable in terms of how we rallied so much?
I mean, I've been in the market since God was a boy. But that a top 30 bank could go under and you'd carry on rallying in equities, I just find it amazing to me. However, I think it's a very, very small number of stocks that are actually driving this market, maybe half a dozen, if even that. And the worry would be if they start faltering and it brings the rest of the market down with them. Now, obviously, we're coming into earnings. How safe are the banks? Really, I have a friendly wager we will see another bank in trouble either in Europe or in the States in the next 6 months or so. So that weighs on my shoulders massively. So you can't just keep having banks go bust. It's
not ideal. I said it's not ideal.
It's not ideal, and I'm not convinced that we're out of the water on Credit Suisse yet. So I think that the merger with UBS certainly raises some questions. I think the cocoa issue does as well for some of the banks and their tier one capital, certainly in the UK. So I'd be watching that. I don't know. I've been so wrong in equities for so long now. I would like to short it up around these levels. I think I don't know what S&P's trading at, something like 4,100. I'd look to get short. But, I've been going short in the face of it for months and months and months. And I've just basically hold my hands up. I've been wrong. Major thing is, can earnings support the prices that we've seen? And can these 3 or 4 stocks at the top of the chain continue supporting the rest of the market? I don't believe they can, and I think there'll be more problems with banks. But hey, that's just my view, and I'm sure I'll be shot down.
I think that's a really good point. I think it was, Adam, you're going to correct me if I'm wrong here. I think it was Torsten Slok at Apollo who had a nice chart out earlier in the week. And I think it was something like 10 or 11 stocks in the S&P have basically powered the entire rally that we've seen on a year-to-date basis. What are your thoughts, Adam? What are the main risks facing the equity market that could derail the trend that's starting to bed in a little bit?
I think for me, and this isn't something which I expect to be kind of resolved in the short term, but there's a clear gap between what the Fed's saying and what the market is expecting, more so for kind of the second half of the year. But if we get a May hike, then that's kind of take us in line with the dot plots, and I think the market would be kind of willing to accept that. I think that would kind of be kind of consensus. I don't think we're really going to see the market derailed or kind of rallied off the back of what the Fed does in May necessarily. I think it's all about kind of the second half of the year. I mean, the market is roughly looking for about 50 basis points of cuts by the second half of the year, more towards Q3, Q4. And it's a question of, do we get that? I mean, the Fed has been talking pretty tough. I know Bullard's non-voting, he's always the hawk, but he's trying to make the point that the market does need to listen to him. And so far, the market isn't listening to him. When we came into this year, it was kind of more of a playbook. We thought we'd see easier kind of conditions in the second half. We'd maybe have a bit of a rally in the second half. But, as Dick's kind of said, this first half performance, or at least Q1 performance, has been a little bit of a head scratcher. We've kind of already got this rally. And therefore, I'm kind of struggling to see that we kind of advance much from here in the second half of the year. I think the market will ultimately be disappointed with regards to rate cuts. And I think the Fed will kind of stay the course a little bit more. I don't think rates are going to go much higher, but I think it'll definitely be stickier than the market kind of anticipates. So I think, the market will, need to concede some ground here to the Fed. I think earnings season is obviously a key risk. I think I was reading a note the other day and said Q2 and Q3 earnings haven't really seen much in the way of material downgrades, but whereas Q1 has. So I think if you see some soft guidance, some earnings season, I think that could be another potential nail in the coffin. And then obviously, as mentioned, financial sector woes. Obviously we saw in the US, it was kind of more regional than GSIB banks that were kind of brought into it. But, we saw that move in Deutsche Bank the other week, which, I don't think they're necessarily out of the woods either. I think they could be a potential target for further selling pressure, particularly if you get a more aggressive ECB as well. So I think I think there is a lot to go on. I kind of think, this Fed's market story is the one that's going to play out, but I don't think it'll necessarily resolve in the short term. I think it'll be more of kind of a second half story.
Yeah, I think the Fed versus the market is a great narrative that's going to play out. I mean, it was something we were doing a poll on yesterday around, who's got this right, who is going to win out. And I agree with you. I think it is going to be the Fed that stay the course, providing there aren't any more financial stability risks.
I think the point to add to that as well for people thinking, I think the way that I'm framing it as well is central bankers were slow on the way up with inflation. It'll be suicide for them to take the foot off the gas, as inflation starts coming down. I think, that's the thing that keeps them up at night. So I think that's kind of the way I'm kind of framing their incentive to stay higher for longer. Yeah.
Unless, of course, you're an Argentinian economist at the BOE and you think rate cuts is the way to deal with high inflation. But, that's a totally different story. Ryan, you're a bit of a gambling man. You're going to take Dick up on his offer on a bet that another bank goes bust?
I'm not going to take that bet up because, quite frankly, I'm not too sure. But what I will lead with is this. This is, I believe, well, first off, I'm a bit concerned about Dickie suggesting how bad he's called equities and how much he's been selling it and how much he's offside, because to me that means that he's going to make me buy the beers next time I see him, possibly tomorrow. So I'm a little bit concerned about that. I've got a feeling that might be the angle he was playing, but we'll see. I do want to make it clear. I want everyone to realise that this is now my 7th trading belows. And the first one, which was on the 25th of January, who remembers back then? And I did say equities higher. And I did say that everything's going to be all right. Path of least resistance is higher. And, I just hope that someone in Trader X is keeping notes of what our calls are. That's all I'm saying. I mean,
we're not, but I'm going to trust you and give you a point for
good.
What may or may not.
But no, I kind of agree with what everyone is saying. I possibly disagree slightly with what Adam said about, they won't be taking their foot, the Fed won't be taking their foot off the gas. It's suicide and whatnot. However, I do think with equities rallying, it means it's one less reason for them to take their foot off the gas. If, as you said, I am a gambling man. I think what the market, as we said earlier on, is about 50-50 pricing the May meeting or May 2nd meeting for the FOMC. I think that's probably about right in terms of pricing. They're not going to hike 50. We know. Well, they won't hike 50. I think there's a massive argument for them pausing here. And if they do, then we have got another leg higher in equities. That will be the instant reaction. If we get a pause, equities go up. Gold, bless them, the gold bugs that get shafted. Just as they're getting up, just as they're unzipping. But yeah, I think also so. Yeah, basically, I agree with what everyone's saying, really. But one thing I will say, and I know I've said it before, this whole up 20%, down 20% bull and bear market, that might have been a decent definition, back in the day, when Dickie was trading, just during the war. But nowadays, honestly, with the way markets move, I really believe that if you are looking for a better gauge of are we in an uptrend or a downtrend, use a moving average, use a 200-day moving average if you really want to use a 100-day moving average. But honestly, I think on every market, if you're looking for are we in a bull or a bear market in terms of where risk flows are going, is it above or below the 200-day moving average? Let's get away from that up 20, down 20% bull. Anyway, there we go.
I may or may not have included that stat just because I knew it would rile you up a little bit. Disappointed you went with during the war and not during the floor.
I did mess it up when I said it. So can we edit that back?
I'm sure Kyriakos can dub over your voice somehow. We'll find a high-pitched voiceover artist to sort that out.
That is cool. From January, need dubbing over as well.
He's checking out.
Yeah, I was going to say, while I go and forensically investigate Ryan's track record of market calls, we'll roll the titles for the second half of the show. So we're going to go back to Ryan, our resident oil expert. OPEC Plus, surprising us all over the weekend. I remember being sat there at about 2:30 on Sunday afternoon, I think it was, when this started to break, sat there reading some research, prepping for the week, and all of a sudden all these red headlines start popping out of nowhere that Saudi are cutting 500,000 barrels and the UAE are joining in, and everyone else started joining in as well. And I think it was about 1.15 million barrels per day when you total up, there we go, all of the cuts that were announced. So it's a pretty coordinated move. It is pretty obvious that there's some coordination going on there. Ryan, what do you make of all of this? Is this going to put a bit of a floor under oil prices for now, or is this more of a kind of short-term measure? Brent will be back under, or WTI will be back under 80 in relatively short order?
So first off, as you said, it was a surprise. I've seen fair few tourists, shall we say, saying, "Oh, it was always on the cards." Are
those tourists, just out of interest? Are they?
I don't know. I'm not getting into it. But yeah, it was a surprise. It was 2 days previous that we were hearing from sources that they were going to keep everything the same. So anyone that's telling you that they already knew it, they're just talking out their arse. It's one of those after the battle, everyone's a general kind of thing. So as you said, it was a 1 point in total, led by Saudi Arabia, obviously, 1.1 million barrel per day cut. It was, no matter how you read it or what people say, it was a coordinated OPEC plus effort. So we saw the instant reaction was obviously, when the Globex so if we just stick apples and apples, so we'll just talk about the WTI price, because obviously you've also got Brent, the benchmark. The initial reaction was a 6% jump, and since then it's gyrated around the $80 level. Personally, I do not see this whole idea of $80 now being a floor. I don't believe that to be a case at all. I think as JP Morgan said, the most surprising aspect of the announcement was probably that it's taken them this long, bearing in mind what we've seen in terms of demand and whatnot. In terms of the US SPR buying, it's very clear now that the Biden administration didn't take advantage of the lower stable prices and top up the SPR, so they are fuming. They came out straight away, and first off, they claimed that they knew it was coming. That's complete balls. The White House, the IEA have both publicly frowned upon the decision, which tells you that they're not happy. They're very, very not happy. Personally, you could argue that this is great for US producers, not only because it's been a short-term bump in prices, but more the point that with elections not too far away, Biden with Trump in the news as well, Biden will be looking to get back kind of the news, the headlines, whatever, and get some good vibes going. So we could see him loosen up the limitations on domestic US producers. So you're looking at like your shale basin kind of production could go up. I've seen some estimates going around that saying due to how OPEC have reacted here, we could see an extra 200,000 barrels per day coming out of the US by the end of the year. So that's something, that in turn, when you think about that, is bearish price. Personally, and this is probably going to be laughed at by quite a few people. I don't know what the exact price is now, since we started recording, but it was around 81, let's call it $81.
Yeah.
I will go out on a limb and say barring any supply shocks, by which I mean missile attack in the Middle East or some balls like that. I will say we will close the gap, as in the Sunday night gap, which would be 75.50 in WTI. I say we close the gap to 75.50 in front month WTI before we hit $85 a barrel. I would, if I'm being conservative, I'm going I'm doing $5 either way. If you really wanted me to, I would give you a price for hitting $75 before $84. I think, the price, you could see the initial market reaction. The market did not want to go much higher. and we're still in the recent range. So yeah, I think all this, this cut to boost prices, it's not having, if that is the reason, it's not having the desired effect.
No, it's interesting to that's and there's a lot of logic in what you're saying, and I think it is interesting that price has stalled out a little bit. I think if OPEC were hoping that this would see the price rally significantly, then they haven't got that quite clearly. Dick, what are your thoughts, particularly in terms of inflation and growth? I know you've been concerned about inflation running away with itself for some time to come. I guess this is the last thing that anyone needs, isn't it?
Yeah, I think so. And I actually think there's a very political move by OPEC Plus. I don't know how much influence Russia's had on the decision. I think Biden certainly upset the Saudis, so they're pushing an open door to raise it. No one's talking about them actually cutting back even more than they have done. So, I wouldn't discount that happening. I agree with Ryan. It's actually been underwhelming the way that it's moved. I would still actually be a long-term buyer of oil. If I saw it dip back down much below 80, I think I'd load up there. Inflation-wise, it must come through eventually into the inflation numbers. However, if you've got a recession, and not being an economist, I might be wrong on this, but presumably you consume less oil, so that there is less impact in the market. But it goes back to what we were talking about earlier. I still think we're in a higher for longer environment. I think the Fed will hike again, may well pause. But I think that the era of low interest rates, as I've said before, is well and truly over. And little shocks like this will keep nudging inflation up. It's not falling as quickly as people want. So I think that will add to inflation, will add to the Fed tightening a little bit more than people expect and staying higher for longer. There's also always this problem, as Ryan alluded to, with Israel and Iran. It doesn't look like that's going to go away anytime soon. So again, being old, there's always a knee-jerk reaction that you buy oil. Shale takes a long time to come online, so I can't see that happening. So I do think it's inflationary, but I do counteract that with we are looking like we're entering into a recession, which will just temper the impact on that. So all in all, I think that it's actually quite a worrying move, and maybe the first of many moves that you see Russia, the Saudis, the Indians getting together, and the new way of looking at the world as the West declines. And certainly America, to me, is in decline. And I think that they'll just come and start squeezing their power a little bit. And China's obviously putting some strings in the background there as well.
Well, I guess that's the big risk, isn't it? Do you end up with a situation where it becomes a little bit of a kind of reverse price war, where more and more cuts take place to attempt to force price higher and higher?
Sorry, can I just quickly add one quick thing onto what Dickie said? No, but I'm agreeing with Dickie in terms of the political.
Talked enough already.
So sorry, I apologise, but this is why Dickie deserves an extra point about the political move. Because he's exactly right. Because we did see in the FT that one of the Riyadh, so the House of Saud, really, really annoyed that the fact that the US didn't top up the SPR when they had the opportunity. And apparently they've just said, okay, well, if you're not going to top up when prices are down there, well, what's the point in us keeping them down there? So Dickie deserves another point about raising the political motivation.
Well, there you go. Since you asked so nicely, Dick, I'll give you another point.
You can have one of mine.
Boom, boom.
Adam, what do we make of all of this? Where is this whole saga likely to go next? Do we think more maybe on the horizon, or is this kind of a one and done move?
So, I'd like to comment kind of on the kind of growth inflation element first, which kind of helps me frame things. I think John Authors had a good piece about this the other day. I think you need to consider, this move in oil, what's actually driven it. And this move in oil is a preemptive supply reduction. If you want typically, if you want to see a sustained move higher in oil prices, you need a positive demand surprise. And that's not what's taking place here. We've seen some from the softening of the data this week. And therefore, I think, if this is an isolation, just a production reduction and a preemptive one, then I think if anything, this is actually going to potentially weigh more on the growth element even more. And therefore, I don't really see it actually filtering through in isolation into inflation much more. I think if you kind of try to put higher oil prices on the market, then I think, the demand destruction element will kind of counterbalance that if this is kind of a one and done move. I think, when it comes, and I think that's why kind of at the start of the week, you didn't really see yields really too reactive to this. And you didn't really see much in the way of central bank speak hitting the wires saying this is a big problem. We need to think about this.
Well, yields actually fell, didn't they? Sorry.
Yeah, exactly. Yeah. I mean, obviously did have the soft ISM as well, which was part of it. But the fact we didn't see yields moving higher off this, I think tells you everything you need to know. Whether they do further moves on this, I don't necessarily know. I don't think anyone knows because no one knew the first move was going to take place anyway. I think, it's very much just a guessing game, whether it's a shot across the bows to the US to kind of, get them to replenish the SPR. I don't know. No, I don't think anyone really knows. But from kind of an economic framework standpoint, I stick by the point that, unless there's more support from the demand side of the equation, I'm struggling to see a kind of sustained higher move here in inflation. I actually saw a note from ING, and this is kind of everyone's the takeaway. It's all about the 3 Ds when it kind of comes to inflation potentially remaining above target. Ryan, stop giggling.
I can just hear Ryan.
Demographics, decarbonisation, and deglobalisation. If you want a framework for inflation kind of remaining above target, that's kind of where we're at. And I don't think this really is too much of a game changer at all.
No, I think that's a really good point around the demand side of the equation. And I think that's probably something that's gone a little bit under the radar, actually, in terms of all the discussion that you've seen. Everyone's talking about supply cuts, but as Dick rightly said, and as you followed on from, if the economy is slowing, there's not going to be a huge pickup in demand anyway. And you are starting to see that data just begin to weaken off a little bit, the PMI numbers and the JOLTS figure as well. So let's get into the data a little bit more in the last round of the show. So the US labour market report for March is due on Friday. Please bear with me for a moment while I turn into Victor Meldrew and moan that the BLS decided to do this on Good Friday. What on earth were they thinking? It's a long weekend. Half the markets are shut. Even the markets that are open will have abysmal liquidity, abysmal volumes. The Treasury market is opening, especially for the labour market report to drop. I actually haven't got this prepared. I just think it's an absolute shambles. But there we go. The stats agencies around the world have been a shambles for some time, so I guess we've come to expect it. Anyway, with that rant over, what are we expecting from the jobs report? I think the consensus for the payrolls print was around 220, 225 when I looked just before setting up to record the show. Unemployment set to hold steady at 3.6%, and the average hourly earnings expected to rise by 0.3% on a monthly basis. Adam, we'll start with you first because I'm sure Newsquawk will be working and squawking the event live. What should we really be looking for to move the markets that are open over this jobs number on Friday lunchtime?
Yeah, I think, adding to Rand, I think the only person crazier than the person at BLS who's decided to have on the Friday is the person who's going to try and trade this on Friday.
Yes.
FX will be open. I've squawked it before, and it was a waste of an hour of my life. But that's in terms of this report, I think people should not necessarily use it as a trading opportunity, but part of kind of finessing their macro framework around for what to look out for in May. I think in terms of kind of the consensus, if we get that, I think it just kind of atones with the March statement, which characterised job growth as robust. I think the risks around this one are slightly asymmetric. I think if you get a good report, I think it kind of solidifies expectations for May. But if you get a bad one, I don't think it's enough to necessarily lean into a pause. I think you kind of get the usual Fed rhetoric of we need to kind of see a string of reports in order for us to kind of change course. And considering non-farm payrolls reports recently have been relatively encouraging, then I just don't think one report in isolation is going to be enough. It's also worth noting from a calendar perspective, obviously the meeting is next month, but it's early in the month. So this is the last NFP report we actually get. And I think it's the same for CPI this month as well. I think in terms of, the headline will also always be used as a growth proxy. But again, I still don't think we're necessarily going to get too much. In terms of the potential downside risks, then, obviously there's a lot of financial stability concerns. But I think ultimately, that central banks have kind of shown that they can, they do have a playbook for, ultimately being able to separate inflation fighting with financial stability. So I think ultimately, this isn't really going to do anything to change the outlook for May.
No, I think you're absolutely right. And I think your first point around trying to trade this, you'd be a lunatic if you tried to trade it, to be quite honestly. One person who certainly won't be, because we all know where he's likely to be on a Friday afternoon, is Ryan. What do you expect from the jobs number on Friday?
Well, so firstly, I think Adam's frozen. It's a very unfortunate pose. So firstly, I've heard a vicious rumour, as I do, my ear to the ground. I can hear Buffalo coming. Sorry. God, Ryan. I've heard a vicious rumour that this is because they are concerned about calendars going wrong at the BLS.
Wow.
And we have had issues in the past where their calendars have messed up, because basically Excel errors. And I've heard a vicious rumor that it's related to that, which kind of makes sense, but also is shambolic. But at the same time, at least we know that there is a reason for the idiotic idea of having it on Good Friday. In terms of, I've got to say, Adam deserves a point. He's exactly right. Why would anyone want to trade it is beyond me. I don't even, as we all know, I don't like trading at the best of times. I think it's ridiculous. I also hate the concept of trying to guess what this number is going to be. And I will not be dragged into.
For some of us, it's our jobs, right?
Well, but this is why you get paid the big bucks, Michael.
Do I?
No, I don't know. Well,
are my bosses watching this?
Yeah, exactly. Well, not paid enough. He's not paid enough.
Thank you. Bonus point.
Yeah, even if I could trade it, I wouldn't be coming into this with an idea of what's going to happen. As always, if you are going to trade it, sorry, another train's going past. If you are going to trade it, be reactionary. Don't expect much out of it. Again, I've got to say, Adam nailed it as well. Use this to help form your opinion, but hold that opinion very, very loosely, because one set of data doesn't, one swallow doesn't make a summer, right? I just hate NFP, really. So you're talking to the wrong person.
It is one of those things. It's a love-hate thing, and I think most people are veering more towards hate at the moment. Dick, what are your thoughts, not just on the payrolls print, but on the US more broadly? I saw a video you were doing with Mr. Blake Morrow yesterday. I assume you filmed it, where you were saying it's too early for people to be getting bearish on the dollar. Why don't you expand on that a little bit for us in the context of the jobs number?
Yeah, I certainly think there's a lot of people getting bearish. It's going to end. It's not going to be a reserve currency any longer. Going back to what I was just saying about this unholy alliance of Russia and India and China and the Saudis. I know India are now accepting payments in rupees, and more people are looking to use yuan. I just think it's too early to kiss goodbye to the dollar. Full stop for the foreseeable future. In the short term, it may well be that it comes off a little bit. I'm actually quite interested in this non-farm number. I can ask you a question. Are Pepperstone trading on Friday? Will they be open?
Pepperstone is trading on Friday, yes. FX, and I think that's probably about it. I think equity futures in the US are open until about 2:15 UK time. But apart from that, pretty much everything is going to be shut. And as you say, even if brokers, Pepperstone, whoever you trade with are open, I think you'd be a fool to go anywhere near it, to be honest.
The liquidity is dishwater at the best of the time. On a perfect non-farm payroll day, the liquidity is bugger all. And as Dickie said, why, I'll give you a clue. Dickie's not going to be in the office.
I'm going to be on the beach, I expect.
There you go.
In the office, although I do have an appointment on Saturday morning at 7 o'clock to talk about it to Bloomberg Dubai, which I can't wait to do. I'm asking about Pepperstone because if you've inadvertently got a position, just get out of it. Don't have any position going into the number. As far as what the number is going to be, absolute crapshoot. I think Michael pointed out earlier in the week that we've had 11 beats out of the last 11 numbers.
That's right. Yes, the longest streak I feel like I'm answering this for you, Dick. I might steal some of your
I'd like to interview you.
Well, you did lose a couple of points the other week, so maybe you can make them back up.
It's yeah. So I pulled the data going back to 1996, and this was from Bloomberg, and yeah, it's 11 beats on the payrolls number compared to the consensus, which is the longest run as far as their data goes back. Which part of me goes, it's bloody surprising how resilient the US labour market's been, and part of me goes, this run can't go on forever. Wouldn't it be great, and wouldn't it be ironic if it broke on Good Friday when everyone is putting their feet up, when half the markets are shut?
And let's not forget, for most of the market, for a lot of the market, markets are closed on Monday as well.
Yeah, of course. Yeah.
It's like,
Well, I think the 11 that there were 11 sackings in the Premiership, and Potter was the 12th, wasn't he? So whether you're going to see the non-farm payroll match the Premiership in managers going, I'm not sure. I just think that if you're asking for a number, I actually think it's going to disappoint. I think Jolt's number last night was a disappointing number. The ADP figure that just came out when we started recording this, I think, is a disappointing number as well. So I'd look for a disappointing number there, but I'd also actually look into the detail of it. Because I'm not convinced the headline number is that important or as important as it once was. I think the participation and the wages are as important. The unemployment level, I'm not convinced is terribly important.
Yeah, and to add to your point, Dickie, and you've made a very good point there. About the headline not being overly important, or not being the be all and end all. Yeah, I've always said headline for show, revisions for dough. Like, I want to see what the revisions are on the previous, because at least then they've had more time to look in the actual data. I know it's a very old traders trope about headlines for show, revisions for dough, but it's legitimate because these numbers get revised for a reason, because their first pop at guessing what it is. It's always wrong. It's very, very unlikely that NFP revisions for last month are going to be zero.
Yeah.
I think
there will always
right.
be the revision. It was always a nightmare when I was trading on the floor that you'd fill an order and you'd get the revision. You go, oh my God, I thought that was a good fill. And it turns out it was an absolute nightmare. So if you're watching the revisions there, are the first signs of recession starting to come? Yeah, maybe they are. And also, a lot of these non-farm figures have been influenced by the weather in the last 6 months or so in the States. And I don't know whether we've had any major weather events in the last month. Certainly plenty of train crashes, whether that will play with the numbers as well. So, just basically don't trade, just watch the number, rub your hands, have a nice lunch on Good Friday, prepare for the weekend, and then come back refreshed on Tuesday. I'm not sure I'd even trade it Monday. You've also got CPI next week, haven't you, I think, in the States? I'm not asking you a question. You have got CPI out in the States next week, which I think is as important as the non-farm figure.
No, I would absolutely agree with that. I think the best strategy on Friday is, and sadly I won't be able to do it myself, but put the television on, crack a beer open, watch the payrolls number come in, and with nice, relaxed, put your feet up and don't worry about trading.
I'll go a step further. Go and crack a beer open and don't even look at what the NFP number is.
Or that one. Cool. Well, that is the end of the show. So let's have a look at the final scores. So the final scores on the doors, it's a shared wooden spoon award this week. Dick and Adam coming in joint second, let's put it nicely, on 22, and Ryan doing a rather strange little jig in his kitchen, winning on 24. Ryan, congratulations.
Thank you. I'd just like to thank the Academy. Thank you.
It was that promise that you were going to buy me a beer tomorrow that got there. That's what it was.
Mate, I've always said bribery gets you everywhere.
Oh, it gets you a long way on this show. Cool. Well, that brings us to the end of another episode. Ryan Paisey from PiQSuite, Adam Linton from Newsquawk, and Dick Matthews from Pardus FX. Thank you, as always, for joining us. Thank you, as always, for watching as well. Please drop a like on the video, leave a comment, let us know your thoughts, and if there's anything you would like us to discuss. And we'll be back with another episode very soon indeed. Thanks for watching, and goodbye for now.